While you invest in stock markets, you have so many options you have to invest in the market. There are tens of thousands of stocks where you can invest in stocks, or you can liquidate the stock instantaneously. The market is very liquid. In this video, we are going to be talking about 5 most important rules when you invest your money in stock market. Number 1, you should not trade your stocks. What I mean by that is, if you do enough research and if you are confident that your stock is going to do well, you should not sell stocks. You should hold your stocks for a long period of time. And stock market investment is not a instantaneous, like a momentarily thing. You have to be investing for a long period of time to get the benefits of market growth. Sometimes there could be many external factors, nothing specific to your stocks, but market might still fall. Say for example, there could be some kind of, say for example, Federal Reserve, they raise rates, or if there could be like a war, or if there is some kind of black swan, for whatever reason, stock market suddenly can fall a lot. But if you convince, if you have the do enough research, and if you're confident that the stock you have invested over a period of time, stock is going to bounce back. Say for example, Warren Buffett in his Berkshire Hathaway portfolio, stock had fallen over 50% on 3 different occasions, and the market and his portfolio, it always bounced back. So what I'm saying is
that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period, and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote and never pay it. You don't need to pay attention to them. I mean, the main thing to do, and you're not going to pick the bottom, and nobody else can pick it for you or anything of the sort. You've got to be prepared to, when you buy a stock, to have it go down 50% or more, and be comfortable with it as long as you're comfortable with the holding. And I pointed out, I think a year, maybe 2 years ago in the annual report, well, just the one before this most recent one, I pointed out that there have been 3 times in Berkshire's history when the price of Berkshire stock went down 50%. 3 different times. Now, if you owed it on borrowed money, you could have been cleaned out. There wasn't anything wrong with Berkshire when those 3 times occurred. But if you're going to look at the price of the stock and think that you have to act because it's doing this or that, or somebody else tells you, well, how can you stay with that when something else is going up or anything? You've got to be in the right psychological position. And frankly, some people are not really careful. Some people are more subject to fear than others. It's like the virus. It strikes some people with much greater ferocity than others. And fear is something I really never felt financially, but I don't think Charlie's felt it either. Some people can handle it psychologically. If you can't handle it psychologically, then you really shouldn't own stocks, because you're going to buy and sell them at the wrong time. And you should
not sell your stock, liquidate when the market is really falling a lot. You should be riding the stocks, have enough confidence, and ride this the turbulence, so that your portfolio, your stocks will have the time to recover. That's number 1. Number 2 is that you should do enough research. You should always try to see, you should know about the company, what sector, what kind of strength of the company, so that the stock is going to be viable for a long period of time, and financially it is going to be doing well. They're going to be earnings. Their earnings are going to be growing. They're in terms of competitive advantage compared to the others. The stock is solid, and for that you could always look into good, like information like Wall Street Journal or Financial Times, and read all this like quarterly the financial statements, where they will tell you what kind of earnings, their assets, liabilities, everything will be in public companies. They are required to disclose all this information, any kind of important events that happen during the quarter, so you get to know all these things. At the same time, you also should not listen to other like rumors, speculations, or like analysts speaking on televisions, because all these people, they basically work for the company and they work for their clients. Their goal is to sell more stocks. Their interest is for their clients and their their owners, and not for you. At times they get commissions. The more they sell, they get benefit. So it doesn't really care if the stock goes up in your portfolio. And oftentimes they might give recommending not very good stocks. Say for example, in year 2008, a lot of toxic stocks like prime mortgage environment, people ended up investing in a lot of bad stocks. Look at this video from Jon Stewart with Jim Cramer, what the environment was at that time, so we'll get an idea what really was going on.
President and I talked earlier in the day yesterday about watching it. I enjoyed it thoroughly.
What was it? A major speech? A legislative breakthrough?
How the hell did we end up here, Mr. Cramer?
No, it was Thursday night's Daily Show, where host Jon Stewart skewered CNBC financial pundit Jim Cramer.
I can't reconcile the brilliance and knowledge that you have of the intricacies of the market with the crazy bull I see you do every night.
There's a market for it, and you give it to them, and I think
there's a market for cocaine and hookers. You knew what the banks were doing, and yet we're touting it for months and months. The entire network was. And so now to pretend that this was some sort of crazy once-in-a-lifetime tsunami that nobody could have seen coming is disingenuous at best and criminal at worst.
Like a prosecutor bearing down on a decidedly uncomfortable witness, Stewart argued that the financial network, and by extension much of the business press, had given the public a false sense of financial security.
The Bulls and the Bears are duking it out.
But as Stewart himself said, Jim Cramer was not the real target of his anger.
The voice of experience you can trust.
And CNBC is at root a symptom of what has happened over the last year and a half. It's a network with a very small audience, about 300,000, but a very affluent one, with a relentless, at times hyper-caffeinated intensity that's focused on the day-to-day movement of the markets.
It's been another one of those days, up and down and up and down and up.
The reason they exist is to do this moment by moment, what's going to happen tomorrow. And, I think that's pretty much a mug's game in terms of what it can actually tell ordinary people.
And you guys knew that was going.
The core of Stewart's anger is his belief that in its coverage and in its lack of skepticism, much of the press was painting one picture to the public while knowing full well that the reality was very different.
That it is a game that you know is going on, but that you go on television as a financial network and pretend isn't happening.
Actually says,
and also do not even listen to the CEO of a company, because the CEO of the company is the best salesman. They do not always tell you the real truth. Their aim is to basically pump up the stock price. Just now, say for example, currently Boeing stock has fallen like 30%, but their CEO, they were selling great things that was going on with the Boeing, whereas they had so many problems and they never disclosed properly. So please do your research, invest properly. This is your money that you are investing, so you should be knowing and not let other people to manage your money 100%. So you should be knowing without blindly put your money in the stock market. bad shares. So you got to be really careful. Number three is that you should also have a contrarian mindset. I mean, what I mean by that is that the stock market is basically runs on a lot of greed or fear. Sometimes on the good time, there will be like a lot of euphoria, a lot of market stock will unexpectedly go very high, and then obviously the market averages it out, or in the fearful time in a bear market, say for example, market could fall a lot. So when you have confidence, when you have research, when you get good opportunities, basically at the fear, people should get adapt to your positions, because if the market always maintains a moving average, stock, if it falls down, you'll have the time to accumulate stocks, buying in the dips, so that you can profit down the line when the market goes up. At the same time, if there is a lot of euphoria, sometimes in year 2000, all the internet stocks and everything, there is huge amount of speculations. So you should not listen to the speculation and buy stocks when stocks are very high, thinking it's going to go even higher. So you got to be have a contrarian mindset and invest properly with that mindset. Number four would be is that you should not invest in with margin. Margin is basically borrowing money and investing in stocks. It is very dangerous. To create a margin, you have to give maintenance initial margin, and if the stock falls, if it hits the margin, the maintenance margin, you have to basically give money to the brokerage companies, so that you can continue to hold your position. And if the stock market, if the stock still keeps falling, you could get a margin call, meaning that the brokerage company would have the power to sell off your liquidity your position at a very low price if you cannot bring additional money to cover the maintenance call. So what might happen if the market falls 60-70%, and if you cannot bring up your maintenance, cover your margin, then the brokerage company, your account, they will liquidate the position and make you lose a lot of money, and you may not be able to recover. So it's not a good idea at all to invest on stocks on margin. And the last point 5 I want to say is that you should diversify your portfolio. What I mean by is that you should not have one or two stocks and put all your money in couple of eggs. You should always diversify, because stock market could go up or go down. The theoretical price of a stock could go to $0, and if things go against you, and if you do not diversify, you might end up losing a lot of money. Diversification, basically it adds it correlates stocks, so all the stock usually don't go up or go down at the same time because of the stock market correlation. Or say for example, if you have stocks in different sectors or different industrial, semiconductor or energy, so they have different characteristics of when they grow, the stock goes up or down. Or at the same time, say if you invest in the same sector, say if you buy Ford or General Motors, usually they're positively correlated, so stock could fall, either go up or go down at the same time. So it is risky to basically put everything in one basket. Usually you should not put more than 10% of your portfolio in one particular stock. You should have 8, 9, 10%, and divide it up to construct your 100% of your overall portfolio, so that you don't take too many concentration risk into this in your portfolio. So those are the 5 important points. Like I said, the first one is to do not trade your stock Number 2 is do research on your stock. Number 3 is have a contrarian viewpoint. Number 4 is that do not trade on margins. And number 5 is to have diversification on your portfolio. So hopefully you found this information informative. And if you liked it, please click the like button and subscribe the channel. Or if you have any questions, I would really appreciate so that I can answer. And have a nice day. Thank you very much.